Good morning and welcome to The Street today, here from Post 35 on the floor of the New York Stock Exchange. It is Friday, February 10th. I'm Catherine Ross, filling in for JD Durkin. We are about 30 minutes into the trading session and markets are trading slightly lower as Wall Street heads for its worst week in almost 2 months. On the show this morning, we'll talk corporate earnings season as over 80% of the S&P 500 companies have released quarterly results. Plus, we'll do a deep dive into the bond market, what it is and why it matters. And we'll discuss the business side of the Super Bowl as companies shell out big bucks for the big game. And finally, we'll dig into Lyft's fourth quarter report as its shares continue to plunge. For more on these stories and so much more, joining us now is our senior editor and chief markets correspondent, Martin Baccardax. Now, Martin, markets are headed for their worst week in almost 2 months, as I said. What are some of the main factors dragging down investor sentiment?
It's hard to pinpoint it, Catherine, to be perfectly honest, but I think for the most part, stocks are looking at the bond market with a great deal of clarity this week, particularly over the past 2 days. I had a raft of Fed speakers over the past sort of 3 or 4 days. They've been largely on the same hymn sheet with respect to the rate path heading into the springtime. But nonetheless, markets are sensitive with respect to the words that they are hearing from policymakers and to what degree it will affect that policy path. Again, not a great change, but I think given the fact that we've had such decent performance year to date, it's not sort of unreasonable for markets to take some of those profits, remove some risk from the table, and maybe just sort of reassess where we're headed, not only from an inflation point of view, but also from a growth point of view. I think that story is getting a little bit buried in the sense that bond markets are flashing recession risk. We are seeing a pullback in consumer spending, and leading indicators do suggest that we are going to slow down, notably in the first half of the year, and possibly test recession in the second half. So you put that all together and set it against a really solid performance so far this year. It's again not terribly unreasonable to see some pullback over the past couple of sessions.
So you think that this is maybe a sign of stocks coming back down to earth?
I don't know coming back down to earth, and by that I mean I'm not entirely sure that we're going to test those October lows anytime soon. I think for the most part we have had an earnings season that, while not fantastic, it didn't really exceed expectations to the downside. And I guess a better way to phrase that is that it wasn't as worse as it could be. So as a result, you are seeing a little bit of support underneath. There is some decent investor sentiment, particularly on the back of that better than expected jobs report. So I'll be surprised if it's a leg down in a notable way. But at the same time, I'd be surprised if we moved significantly further to the upside until we get better clarity on the Fed rate path and an understanding of the growth projections. So in between that, you can imagine we will be reasonably range bound. And I think, Catherine, to some degree, that's being played out in the VIX. That, of course, is the colloquially known as the fear index. It's a way in which we can calibrate the market's expectations of movements over the next 30 days. It's been trading well below the 20-point mark. When markets were volatile in the last part of last year, the VIX was trading in the mid 30-point range. So that's a big decline in volatility expectations and suggests again that the S&P 500 is likely to remain range bound until we can get a better understanding of Fed rate policy and growth prospects.
Now, when we're looking at next week, inflation is going to be one of the biggest focuses, and we've got the CPI report due out on Tuesday. What sort of figure are investors looking for?
This is a difficult one to calibrate, Catherine, because there's actually going to be a new calculus in effect. In other words, the way that the Bureau of Labor Statistics puts the numbers together is going to change slightly. And as a result, there are some economists who say we could get a downside reading from the new measurement. That is, of course, impossible to calculate at this point because we don't really know the inputs in the way that would give us certainty. But nonetheless, I think there is the expectation that we'll probably see at least a pullback on an annualized basis. And that will be good from a headline perspective, but we may actually see a bump higher in month-on-month price pressures. And that might elicit a little bit of concern from the market, again, when you set it against that really strong payroll data from the month of January, where we saw 517,000 new jobs added to the economy, blasting pretty much everybody's forecasts along the way. So that CPI data is critical. The retail sales data, I think, Catherine, will also be critical because, of course, this is an economy that is going to be dependent on consumer spending and consumer sentiment. I mean, to that degree, we'll get the University of Michigan's closely tracked survey later today. But I'll be interested to see what sort of spending was able to materialize over the month of January, because December wasn't particularly strong. And of course, we know that people do tend to stretch themselves over the holiday season and then pull back in the first month of the year. If that pullback is extreme, it may test the thesis that the job market is going to drive further consumer spending gains into the first half of the year. And that, of course, will cloud, I wouldn't necessarily say cloud, but it might put the inflation reading in a very different prism. So inflation Tuesday, retail sales Wednesday, certainly two back-to-back numbers that will have extreme importance for the markets next week.
And while all of this is happening, we still do have earnings season going on. I mean, we've had the majority of the S&P 500 companies reporting earnings, but there's still some big companies set to report next week. So aside from retail, aside from CPI, what are some of the biggest names you'll be watching?
The benefits of live television, Catherine, I'm going to turn my phone off, which is something I probably should have done already. But nonetheless, we're looking at next week, not a great deal of blue chip numbers, Coca-Cola being one of them, Kraft Heinz being another, and those will be interesting data points in the consumer sector. I think the week after is what's going to be most important, because then we'll get the big box retailers, the Targets, the Walmarts, the Home Depots of the world, and they'll give us a better assessment of where we're seeing consumer spending patterns. But next week will nonetheless be important with some interesting names. John Deere comes to mind, Paramount, what else are we looking at? Cisco, we're looking at Biogen. A decent smattering of numbers, but none that are really going to knock, I think, the market off its perch.
So far, we've seen kind of a mixed earnings season across the board. What are some of the sectors that saw the most success in the fourth quarter?
Well, it's been an energy-driven story for the fourth quarter. There's no question about that. That is absolutely the biggest and most important sector in terms of earnings growth. Essentially now, I think it's about 70% of the S&P 500 is reported. And the assumption is that earnings are going to fall about 2.8% from last year. When you strip out the energy sector, though, Catherine, that decline accelerates to about 7.1%. And actually, again, the major outperformer was energy, industrials, and real estate. And that's not really the kind of thing that you want to look for sustained earnings growth, because they are so mercurial, so cyclical, and in the case of energy, it's just impossible to predict. So that really does raise the specter of whether or not we'll have this sort of earnings recession where we get 2 consecutive quarters of contracting year-on-year S&P 500 profits. And that's certainly what the expectation is now. And it will absolutely be so if, again, you strip out the energy sector in the first quarter of this year as well. So there's a lot to play for in terms of how the earnings story can drive the S&P 500 forward. And of course, we have to set that against the expectations for growth and inflation. So that's why I do think the S&P 500 will remain range bound, because we're simply not getting the narrative from the corporate earnings story that we might necessarily want. And we have so much indecision with respect to inflation and growth at the same time.
One thing that's really stood out so far this earnings season, and you were just talking about an earnings recession, which is leading me here, these outlooks that we've been getting, Martin, I mean, they're a bit dismal. And that doesn't necessarily set us up for the best first quarter. Do you think that these companies are going to be posting earnings that are just as disappointing as their guidance?
This is always tricky to calculate, Catherine, because I think companies have learned how to play. I say learned as if this is something that's only materialized in the last couple of years, but you can go back decades and understand that companies have preferred to guide conservatively and then beat expectations, because that's going to elicit the best market reaction. And ultimately that, of course, is going to drive the investment narrative for your company in the best possible way. So whilst the outlooks have absolutely been grimmer than anticipated, and the numbers bear that out, it's worth remembering that it does make a lot more sense to guide down and beat than it does to set expectations too high and not be able to walk over the bar. So you have to have a slight degree of cynicism with respect to these near-term outlooks and their representation of economic growth. And that's why the mosaic is so important. You need to look at GDP. You need to look at leading indicators, PMI data, the sort of Fed commentary, as well as the inflation path, to understand how companies are going to be able to generate profits and to what degree they're going to be able to return them to you as the investor.
Martin, you said, you both wrote this and then also said this on the show, that the bond market right now is really setting the tone for today's action.
Yeah.
And they've kind of been very involved with the action that we've seen throughout the week. In fact, even looking at the German bonds right now, I mean, that's a bit in the weeds, so I do want to keep it to the American. But because the tone is being set by the bond market, I wanted to use this as an educational opportunity for our investors who may not understand what the bond market is. So I'm going to start with a softball and just ask you to explain what the bond market is and how it differs from the stock market.
Well, the best way to do it, Catherine, is probably to separate the two kinds of bond markets in the main. There is a corporate bond market and there is a government bond market. Now, the government bond market is one that's probably the best understood in that governments are going into the marketplace. They are borrowing money to fund their annual or long-term spending plans. If you are the US government, and let's say that you want to build a series of schools around the country, you're not going to wait for the tax receipts to come in and build the schools. You're going to borrow the money, build the schools, and then pay it back with the tax receipts that you get from hopefully an expanding economy. So the bond market simply represents all of the government borrowing that is out there sort of in the investment world, and it stretches from 1 month treasury bills all the way up to 30-year treasury bonds. Now that structure from 1 month to 30 years is what we call the term structure of interest rates. And in a normal course of events, Catherine, you would like to see short-term rates being quite low and long-term rates being quite high. In other words, investors are going to want more return for lending you money over a longer period of time because there's more risk over 30 years than there is over 30 days. What we have now, Catherine, is what's called an inverted term structure of interest rates. And what by that I mean is that short-term rates are quite high and long-term rates are quite low. That tells us that investors are very worried about inflation in the near term and equally as pessimistic about growth in the long term. That inversion has typically been associated with recessions almost exclusively for the past 50 years. It tends to be the canary in a coal mine, the recession warning, the flashing signal, however you want to describe it. When you have short-term rates that are higher than longer-term ones, almost inevitably the economy turns to recession. And that's a big reason why the bond market is so important for investors and for indeed investor sentiment.
I just want to give a fun fact here before we continue on with our conversation, because I actually, when we first started working together at TheStreet all those years ago, we don't need to age ourselves here, but I did not know pretty much anything about the bond market, and it was only through, we were doing a podcast back in the day where we would discuss oil and the bond market, and that's how I learned through your explanations, Martin.
No, it's incredibly important, and it's a little bit sort of opaque for most people because the data isn't necessarily as accessible as stocks, and most people aren't sort of individually invested in the various portions of the bond market. They generally have exposure over the whole of it. But really, an easy way to understand why it's so important, Catherine, is this. Basically, every piece of financial investment out there, every stock, every bond, every real estate, you name it, is going to be based off the assumption of the price of a US Treasury bond. If the world were to end tomorrow, who would be the one person that we would agree would pay back the money that they owe? That would be the US government. So the interest rate on Treasury bonds is basically the benchmark from which everything else is priced against. So as those rates move higher and lower, they have a ripple effect on stocks and corporate bonds and loans and mortgages and credit cards and auto loans and the whole scope of financial products along the way. It's incredibly important, and it virtually dictates sentiment in markets all over the world, whether it's Europe, China, Japan, or South America. The US Treasury market is the benchmark for investor sentiment, pricing, and indeed liquidity. And that's why it's something that we really should give a great deal of attention to.
I'm laughing, Martin, because if the world does end tomorrow, maybe Last of Us style. I don't think I'm going to be looking for who's paying back the money. I think I'm just going to be trying to make it, you know?
I could have probably said if the world stops tomorrow, maybe, and then
There we go.
restarts 2 days later. That's probably a better way to put it.
Martin, we've kind of touched around this, but we haven't really touched on it yet, which is why would someone buy a bond instead of a stock?
You want to have what's called diversification in your investments because you certainly don't want all of your risk profile to be associated with one portion of the marketplace. Certainly stocks are an enormously important part of anybody's investment portfolio because of the upside return that they provide. But at the same time, Catherine, stocks can go to zero. And as a result, you have sometimes what you call asymmetric risk. In other words, they can go way up, but they could go all the way down to nothing. Now, with the case in a US Treasury bond, the worst case scenario is that you get all of your money paid back and you get paid back semi-annual coupons along the way. So the worst case scenario in a bond isn't really that bad. And as a result, it's a good defensive component of a portfolio. Typically, you want something in the range of sort of, well, let's just say 60-40. In other words, 60% in stocks, around 40% in bonds. Now, those numbers can be calibrated depending on how risky you would like to be. But essentially, you do want to have exposure to risk markets like stocks because of the upside potential that they provide. With bonds, you like the fact that they generate a fixed and predictable income and they offer downside protection again, because the worst case scenario is you get all your money back. That's not a bad deal.
No, it's not. And actually, I was just reading that Bank of America pointed out that the 60-40 records have the best start since 1991, which is
That's right.
something you do want to hear, especially Martin, if, as you just said, the bond market's kind of worried about a recession.
This is just it. And this is probably the most important component function of understanding the bond market, Catherine, and I'm glad you brought it up. Prices and yields move in the opposite direction. So as interest rates rise, bond prices fall. And of course, the inverse is true. Now, a big part of the reason that bonds have underperformed for the past 3 or 4 years is because market interest rates have started to increase as a result of the Fed's policy tightening and indeed the overall global economic improvement. Now, that is probably likely to carry on, and that is going to put downward pressure on bond prices, and as a result, yields are going to rise. But again, the good thing about being invested in bonds is that not only are you going to get paid back, but if you reinvest over the whole of the lifetime of the investment, then your return is going to rise because, of course, you're reinvesting at a higher rate. So bonds can give you nice comfort during the time that you're invested because they move and calibrate as a result of what is happening in the broader financial markets. Stocks, for the most part, are an earnings and growth story, and as a result, don't move mechanically in the same way that bonds do, which is, again, a big reason why you want a balanced portfolio so that you can diversify and get upside risk with downside protection.
Martin, we were looking at the stories this morning and when we were starting to write the show, and we got very excited because we get to talk about the money behind the Super Bowl, which maybe nobody's as nerdy as me, but I think it's very fascinating. And while we know that the Super Bowl is the biggest day of the year for both teams, the Kansas City Chiefs and the Philadelphia Eagles facing off, it's also the biggest day of the year for a number of companies. Now that includes Domino's Pizza, Fox, ESPN, DraftKings. Who do you expect to come out on top here?
This is a really fascinating story in some ways, Catherine, because it goes well beyond sport. I mean, basically, during my youth, it was not uncommon to have these kind of collective national events on television virtually every night of the week because there were so few alternatives. And as a result, some of the biggest shows and programs and specials and broadcasts were watched by nearly everybody in North America. The same is true in the United Kingdom. It's different now because the way that we consume media is entirely sort of bifurcated and personal. And as a result, the nation doesn't get to sit down and enjoy the same event at the same time in any great degree. And the Super Bowl is really the one time of the year that Americans, and indeed most people around the world, can do so as well. So that provides such an incredible level of importance for the businesses that are focused on generating profit from it. You talk about Domino's. This is going to be their biggest day of the year. They said they're going to sell 2 million pizzas alone on Super Bowl Sunday. So that drives both top and bottom line growth for an important company. DraftKings, of course, is one of the market leaders in online sports betting. This is going to be the most bet upon sporting event in US history, Catherine. It's going to generate about $1.1 billion in revenues as a result of the wagers that are going to be put not only on the outcome of the game, but a whole host of other things that go along with it, including, amazingly, the length of the national anthem. So you have the potential for that as well. Advertising for the game itself will be at the highest level on record. Reports suggest that companies are going to pay about $7 million for a 30-second spot during the course of the game. And that's up about 8 or 9% from the prices that were reportedly paid last year. All of this is under the radar, of course, because companies don't like to disclose it. But nonetheless, this is an interesting dynamic in an advertising market that everyone from Google to Meta and all the way down has told us is going to decelerate sharply into the first half of the year. This only again, sort of, Catherine, underscores the importance of an event like the Super Bowl and its a sort of collective audience, because companies get so few opportunities to pay for advertising that they are absolutely certain is going to be consumed. And the Super Bowl is really probably the only event now that you can guarantee that that will happen.
Well, we know that with the price tag of $7 million for a 30-second spot, it's very unlikely that we're going to be hearing from any of those crypto companies that really were just hogging up the screens last year, right?
Incredible. Yeah, the FTX, of course, with that famous advert with Larry David. I think Robinhood, was it Robinhood, Catherine, that had the ad with the QR code as well, that had everyone mystified?
Coinbase, I think.
That was Coinbase. You're absolutely right.
Coinbase.
Yeah. So it's interesting how the ads also represent a cultural zeitgeist at the same time. Of course, last year, crypto and NFTs and online trading and all the rest of it was at its absolute zenith, and it was represented in Super Bowl ads. It will be interesting to see what kind of companies and to what degree they represent sort of the zeitgeist that we're seeing in the US today, which is a lot more conservative and certainly not nearly as obsessed with all things digital.
And now we've got Bitcoin at 21K. There was a nugget in your previous answer, Martin, that really stood out to me, and that was that Meta and Google have warned about ad spending throughout 2023. Do you think that this shows that if a company is willing to spend $7 million for a 30-second spot, is that a good sales indicator for ad sales in 2023, or is it just kind of disconnected?
I wonder. I do wonder, Catherine. I think there might be some connectivity, but I do think for the most part, the Super Bowl is such a standalone event that companies are willing to stretch, particularly those that see their core audience, sort of consuming the event itself on Super Bowl Sunday. There's the old-fashioned assessment of advertising, which I still think works, in that 50% of the ad budget is wasted. You just don't know which 50% it is. In other words, you could throw $7 million at the Super Bowl and not really get your money back, but you might be able to get much more of it back as a result of a targeted campaign that lasts several months. So the bang for the buck isn't necessarily linear, but it certainly puts companies in the frame. And the FTX ad from last year was a perfect example of that. It didn't end well, but that wasn't because of the Super Bowl ad itself. So I think companies are still willing to stretch because, again, they get so few opportunities to have that kind of collective audience. And once they have it, it's worth spending on.
All right, Martin, I'm going to caveat our next question here because there is a wrong answer. I never say that because I think that, all answers are fair, but there is a wrong answer here. And any viewer who has been with me for a while knows exactly what I'm going to ask and what that wrong answer is. Who do you have on Sunday?
Gosh. I honestly don't know.
Friends.
We are very close friends, and as a result, I choose my words carefully. But I do think that the odds makers have it right. They have essentially Philadelphia as a 1.5-point favorite over Kansas City, and I think to some degree that's where the game is going to fall. However, What I do think is interesting is that the over-under for total points at about 51. I don't think it's going to be that high scoring, but I do think it's going to be incredibly entertaining. I think there's a whole host of historic factors that are going to be involved in it. And as much as this does pain the Dallas Cowboy fan, I think you cannot discount the fact that this Jalen Hurts story has just been so compelling over the past few years. For him to have recovered in such a way from being benched in the national championship at the University of Alabama and now leading Philadelphia to the Super Bowl, that's an incredible American story. And as a result, yeah, I think they might have a very slight edge.
You know, Martin, I really had high hopes for this friendship, but it was nice knowing you.
Your head through the whole of that answer.
Sure, you're trying to pull on my heartstrings. I saw that manipulation happening in real time. And I just want to say, I've been on the floor of the New York Stock Exchange all week, out of my home of the Dallas Cowboys land, and it's been painful to be surrounded by Eagles fans all week. So, viewers, I hope you're not Eagles fans, because I'm going to be rooting for the Kansas City Chiefs. I'm hoping that they upset.
Well, I mean, there's every opportunity that they will. Patrick Mahomes, of course, has just been named the MVP of the league. He's had the time to heal that ankle injury, and I certainly hope he's done so, because we only wish him the best from a health perspective. But he's just such a dynamic player, so incredible, and performs so well on the biggest stages. So as a result, I think he may be looking to sort of reclaim a little bit of the disappointment that he had as a result of losing to Tom Brady a couple of years ago. So I think it'll just be one to watch and one for the ages. And it's probably worth mentioning again, Catherine, that this will be the first Super Bowl in history that features two African-American quarterbacks. And that's something I don't think that should be ignored either.
No, completely right. I think that's a really good point and a great place to end at. But I will just say that I'm looking forward to next year's Super Bowl when the Dallas Cowboys are involved. You know, just
absolutely.
All right.
Talk about optimistic
Martin, let's get on. Hey, realistic outlook. Let's go with that, okay?
Absolutely. You're right.
Okay, Martin. Let's move on to our rapid fire segment today, starting with Lyft. What caused the company's shares to tank today?
This is a really big move to the downside. I think ultimately investors are just recalibrating their growth and earnings estimate for a company that's losing market share to Uber virtually by the day. Lyft had a relatively cautious near-term outlook for revenues, which they see sliding on a sequential basis as a result of some difficulties in getting the full driver suite up and running, and particularly some of the late reopening that they saw in markets on the West Coast where the core of their business is. But most importantly, Catherine, they're going to lower prices, and they're going to have less surge pricing as a result of that increase in drivers, which they anticipate over the first 3 months of this year. So now investors are simply just looking at a completely different business outlook and how it will flow through to both the top and bottom line. They don't like what they heard, and as a result, they're taking about a third of the company's market value down on a single session, which is a really big move.
Yeezy come, Yeezy go. How did the Kanye West split affect Adidas?
I mean, this is a massive, massive number. Essentially, Adidas is saying that as a result of their split with Kanye West, they're probably going to see a double-digit decline in 2023 revenues. And they're probably going to hit ultimate profits by about 700 million euros. And that's in a worst-case scenario if they can't repurpose some of that Yeezy branded inventory that still sits on their books. It really is a colossal misstep for this sportswear company, which probably should have seen the risks coming as part of the association with this artist that's been going on for a number of years now. They cut ties last year as a result of some really disturbing comments that were both anti-Semitic, racist, misogynist, and you pick a description. So to their credit, they did cut ties quickly, and now they're counting the cost of that. Stock is down heavily in German trading as a result. They have a new CEO on board who's basically trying to kitchen sink everything so that he can stamp his authority on the company. But nonetheless, it's a pretty astonishing change from the outlooks that we were considering only a few months ago.
Martin, as a fellow Brit, I hate to call you out here, but can you say that company's name again? Did I hear you right?
It's the correct pronunciation is Adidas, although in the United States, Adidas is a lot more common. I just can't get rid of the tick.
Look, my dad's Scottish, and he still swears that they know how to say aluminum better than we do. And let's agree to disagree here.
There's a different spelling between the two words, actually, but I'm with your father on that. It's aluminium.
No. All right. Final rapid fire question for today. Pay me, pal. How did PayPal impress in Q4?
They actually were executing and have been executing incredibly well. And even with the pullback in consumer spending, they were able to generate better than expected profits and a reasonably conservative near-term outlook. Now, the reason that investors are liking what they see with regards to PayPal's outlook is that they aren't blending in further declines in they are not blending in the potential for a rebound in consumer spending. So if, as it turns out, investors see the jobs data and the underlying economic performance as positive, then PayPal could actually step over its near-term outlook much more easily. So investors are rewarding that conservative guide. They don't necessarily appear to be too troubled by the fact that Dan Schulman is going to retire as CEO, largely because he's going to wait to do that until the end of the year. He'll stay on in this transitionary period and indeed stay with the group on the board of directors. So a lot of decent, transparent, and quite sensible statements, figures, and guidance coming out of PayPal, and the market seems to like what it hears this morning.
All right, Martin, thank you for sticking with us, letting me rib you a little bit on this Friday afternoon, or Friday morning, really. And that'll do it for The Street today. You can stick with The Street and for more on these and all other major market stories that matter to you.